So every discussion I hear about house prices and mortgages seems to end up the same way. It always comes down to two things. Boomers had it easy versus we paid 15% interest rates. So instead of shouting at each other in the comments section, let's actually compare some numbers. House prices, salaries, loan to value, and mortgage payments. And then let's have an honest discussion about whether or not a housing crash is coming, or whether this is just something else entirely. Now, first things first, this is not about blaming anybody. I'm not about to jump on any particular generation. Boomers didn't secretly press an easy mode button. And millennials certainly aren't bad with money just because they want to buy themselves a coffee every now and again. These two generations, and the ones following them, are facing very, very different housing markets. Boomers dealt with less mortgage products being available, much higher interest rates, but house prices relative to income were significantly lower. Whilst millennials are facing much higher housing prices relative to income, significantly larger deposit requirements in real cash terms, much tighter affordability rules, and quite often you need two incomes just to get started. They're different hurdles, and certainly not equal ones. And this is where the real gap opens up. Historically, house prices were between 2 and 4 times annual salary. And today, in many parts of the UK, that figure is 6, 7, 8, or even 9 times salary. And the key point that a lot of people miss is that house prices didn't just go up, wages didn't keep pace. So in the boomer generation, you had house price growth, but you also had strong wage growth to go with it. And whilst millennials have seen house price growth, matching wage growth just isn't there. And that changes everything. So now let's talk about deposits, because this is where the argument gets very, very misleading. Yes, the boomer generation put down 5 and 10% deposits, but it was 5% of a house that was worth 2 to 4 times your salary, not 5% of a house that was worth 8 times your salary. The 5% that the boomer stumped up was significantly smaller than the 5% that a millennial was going to pay. An average first-time buyer these days is having to put down 20, 30 or even 40 to 50,000 pounds. All whilst paying higher rents, higher living costs, and often student loans, which didn't exist in the boomer generation. Back then we had free university education, so the percentage might look similar, but the pain absolutely isn't. But then you look at interest rates and mortgage payments, and this is where the boomers can absolutely push back. Yes, interest rates in the 80s and 90s, those that the boomer generation paid on their first homes, were absolutely brutal. You were looking at 10, 12, even 15%. But let's put it into context. Loan sizes were a lot smaller relative to income. You had wage inflation, so although your first couple of years might be painful, you quickly grew out of it. And loan to values dropped quickly because house prices rose. So yes, today, mortgage rates are less than they were in the 80s. Typical first-time buyers are paying 4.5%, 5.5%. But we keep coming back to these loan values, and they're much bigger. And people stay in the high loan to value area for years because we haven't got the house price growth. So yes, boomers did pay higher interest rates, but millennials are carrying a lot more risk for a lot longer. So what does all this really mean? And the question you often hear is there a house price crash coming? A 2008 style crash is highly unlikely, and this is for a number of reasons. Firstly, lending rules are a lot tighter. Back in the 2000s, banks barely bothered to check your income before they lent you money. These days, when you take out a mortgage, generally it is stress tested, which means the mortgage you get is tested at a much higher percentage interest rate than the one you actually get. It's done to make sure you can cope with a rate rise. On top of that, employment figures are still relatively strong, and we still have a housing shortage. But that doesn't mean that everything in the garden's rosy. And yes, it does feel like there's a crash. House prices in London have dropped a bit, but this is less of a crash and more a long, uncomfortable period of stagnation. We're currently seeing forecasts for around 2 to 3% house price growth for 2026. So that's 1% under inflation. So in real terms, yes, it is a drop, but it's not a crash. And whilst historically UK house prices do rise over the long term, it is all about the long term. There's dips, there's flat years, and there's uncomfortable periods like this one. The real takeaway here isn't about generations. It's about buying sensibly with a mortgage that's structured so you can afford it comfortably. So an understanding of your numbers and your financial goals matters far more than any social media debate. So if you're trying to work out whether buying, waiting, moving or remortgaging makes sense for you, rather than your parents or the internet, then that's exactly why proper advice from a broker like myself matters. I'm Patrick Weightman, your local East Midlands mortgage and protection advisor, serving clients up and down the UK. Links are in the bio. Speak to you soon. Bye bye.